program, KCAA, the Inland Talk Express.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show, for listening to us each and every week. If you want to see this show, you can go to YouTube. Jeff Barton, the Mortgage Voice, is on YouTube. Been there for years, numbers of shows, hundreds of shows. You can look back to see what kind of shows we were doing, a year ago, 6 months ago, 8 months ago. The reason I suggest that is because we've had a lot of different changes within the mortgage industry over that time period, and we look to, obviously, more changes coming as we push through the year, whether it's, having to do with inflation, whether it has to do with interest rates rising, whether it's the Fed interest rates or whether it's the mortgage interest rates. And those are two distinctly different things that affect each other a little bit, but not necessarily if this goes up, that goes up. So interesting things to talk about in the show. So if you want to see us, if you want to go back in history and see us, go to the YouTube, Jeff Barton, the Mortgage Voice. That's where you can find me. Okay, so I'm coming to the show today, and I'm here in a great studio up in Ventura County, California, and I want to say hi to my friends at KCAA, those great people who deliver the show to the Inland Empire and everybody out there. Hi, I really appreciate you listening, as I said. So I'm driving here to the show and trying to figure out exactly what I was going to talk about other than the notes of what's happening in the industry. And I was thinking, there are so many changes that you go through in life. And I know young people who are listening to the show, probably first-time home buyers or prospective home buyers, are anxious to hear whatever the rates are today and whatever the programs are. People who are obviously raising kids, maybe some high school kids, they have some different requirements. Maybe they need a little bit bigger house. Maybe they need some other things to educate themselves about. Maybe taking money out. Do I do a second? Do I do a refi? How do I do that? Access my equity in my house. And of course, there's older people my age and above, who are thinking, maybe it's time to downsize. This is a great market to sell your house in, and I'll probably get the best price today that I'm going to be able to get, or at least pretty close to it. And these different areas in life and how the mortgage rates and how the mortgage programs and how money in your house or equity in your house, how it affects your lifestyle and how much of it do you think about on a daily basis in terms of trying to use that equity and what you're going to do with it. It's taxing, and most of us are not professionals in that particular area. Anybody contemplating that usually has a reason that they're taking money out of their house. Oh my gosh, kids need college fund. All right, let's take money out of our house. Oh my gosh, there's a health emergency. I need this money and I need it today. I got to take it out of my house. Or I want to lower my payments, so I want to go to a longer term type interest only, and that's what I want to do. So what is your particular issue, and where is it you're at? What are you thinking about right now when it comes to housing, when it comes to the interest rate on the loan that you're going to get for that housing, and what are your needs? Remember that the professional that you use and choose has to have your best interest at heart. And so having these types of conversations with them, being honest, being upfront, letting them know exactly what you're doing so that they can get you into the correct program with the correct payment. And I can't stress that enough, especially in uncertain times. What do I mean by uncertain times? All right, let's get into a little bit of the statistics that I have here so that you can understand what I'm talking about. 71% of Americans are setting more money aside than they were a year ago. 71% of all Americans are setting money aside, meaning that they're putting it in their mattress or in their bank accounts or wherever you put money when you want to have it readily available if you need it. And the reason that is, there's only one reason: recession fears. Now, why are there recession fears? We see unemployment the lowest it's been in forever, 3.5%. Well, there are signs and have been signs and predictions, and there have been predictions for a year, that this particular inflation cycle has caused the Fed to raise their short-term interest rates which in turn will cause a recession, because the only reason the Fed wants to raise rates is to slow the economy. Now, as we all saw, when we didn't see the Fed do it early enough, is that inflation caught fire and was at 9% a year ago. 9%. And that's still killing people out there, and I understand that. So if you couple the 5% inflation that it is today, as well as recession fears, you get fear in the marketplace, and that's where a lot of Americans are right now. They're afraid that there may be a recession that may take their job. Now, there are a lot of counterpoints to that. One of the major counterpoints is, wait a second, we have unemployment of 3.5%. We have 1.6 jobs available for anyone looking for a job. Well, the underlying to that is 3 months ago it was 2 to 1. So that number has come down a lot, from 2 to 1 job openings to 1.6 per job opening. Meaning if you're looking for a job, there are 1.6 jobs available for you. 3 months ago, there were 2 jobs available for you. Now that alarming number, even though we know that there's 9.5 million jobs out there that are going unfulfilled, could easily change. Now, in my particular industry, in the mortgages and real estate business, we've seen, obviously huge downturns. I think last week I read out about 4 or 5 different companies that were really either merging or have been bought or have lost huge amounts of money in the first quarter of the year. I think United Wholesale, which is they and Quicken or Rocket Mortgage, they trade back and forth as to who's the biggest, but United Wholesale lost a ton of dough in the first quarter this year, not last year. Another one, Mr. Cooper. Mr. Cooper is a company that services a lot of loans. And in the marketplace, when times are tough in the lending business, we see a lot of mergers, we see a lot of acquisitions. Mr. Cooper just bought Home Point. Now, Home Point was one of those companies that went public not all too long ago. There are 5 or 6 that I think I rattled off, United Wholesale being one of them, and obviously Rocket Mortgage being another. And the stock price and the share price, they're trying to get the public to fund those particular companies in order that they either do their expansion or they meet their net worth requirements in order to be able to service loans. Whatever it is, Mr. Cooper just bought Home Point, which was one of those companies that went public. And they paid $324 million in cash. And apparently that was a bargain. Now, I don't know the finances of a lot of these larger companies. I do not know the wherewithal by which they're judging whether this is a good deal or a bad deal. But when I read that $324 million is a good deal and that they actually are picking up a company on the cheap, that leads me to believe that the marketplace for mortgages is obviously, as I was saying, not in great shape. And that's true with the mortgage industry, it's true with the real estate industry, and it may be true soon enough in industries that you're thinking about, which is why recession talk is something that is the mainstay of what we're talking about here. We talked about the 3 groups of people that are interested in possibly refinancing or downsizing or taking money out of their house, and there's several dozen different ways that you can be able to do that. But the main reason to be able to do that is, like I said, 71% of the people in the U.S. are putting money aside because they're afraid that the economy, the jobs that are out there, that recession is coming. And nobody wants to get caught short with having cash, especially if recession is the actual thing that's going to be happening. Now, when are we going to find that out? Good point. When are we going to find that out? Well, as we move closer and closer to midpoint of the year, we're currently a couple of weeks away from the end of May, and obviously the end of June is second quarter will be finished. We'll get closer and closer to that answer. The Fed, they may continue raising rates. I think we've got one more in us, and then maybe some pause, and possibly by the end of the year, some reduction, especially if we do see that recession coming in Q3, Q4. I think all of these are in play, but I think as a result of this large number of people holding on to cash, that in turn does exactly what the Fed wants you to do, which is slow the economy down. 2/3 of the economy is consumer spending. If consumers are putting money in their mattress or in their bank, they're not spending, so we're going to get that that inflation-fighting downturn in the economy. Question is, how long and how hard? I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show where we provide to you information on mortgages, the availability of funds, what's happening in the real estate world, and all sorts of other things. Listen, if you want to see this show, you can go to Jeff Barton, The Mortgage Voice on YouTube, or you can go to themortgagevoice.com. That's our website for the show. On that, you'll see not only the shows themselves, but you'll see some profiles of the guests we have on, and you can contact them directly. And a lot of times, that's the best way by which you can get answers to any of these questions. And certainly, you can get them from the guests we bring on to the show. And today is no exception. Bill Orr joins us, who is from Malibu Funding, and I want to bring him on right now. Bill, how are you?
I'm great, Jeff. How are you doing today?
I'm okay. Thank you very much. I'm trying to figure out where the economy is going, what's happening with inflation, what's going on with all these distractions that really affect purchase and buyers' mentality when wanting to buy a house. So I wanted to talk to you a little bit about what's happening. Let's say I'm a renter, and I'm somebody who's been renting for a number of years and really wants to be able to get out of that and get into something where I can own. I'm tired of renting. Prices keep going up. If I don't get in now, I may never get into. What's your advice to some of these types of borrowers?
That's a great question. So the advice is to jump now.
Right.
Get into a house any way you can. I don't want to get into specifics, but I bought my house in 1989. And what it's worth now versus what it's worth then is insane. And you know what happened? I just bought it, and I made my mortgage payments. We fixed it up here and there, but it wasn't like I put all this money into it. Actually, we did over time. But
right.
The main thing we did is we just bought it. We made the payments, and the economy goes up, economy goes down. This president, that president,
right.
This Federal Reserve chair, it doesn't matter. The real estate's going to go up, and the house, the worth of our property right now versus what we paid for it, the difference is incredible. So my point today is what we're going to talk about is if you listen to the show right now and you want to be in a situation where, 5 years from now, 10 years from now, 15 years from now, you've picked up hundreds of thousands of dollars of equity in your house, means it's worth more than what you paid for it, you have to get into a house any way you can rob Peter to pay Paul, just do it. So here's a couple ways. Go ahead.
Before we get into the specifics now, I know you have a number of different programs or ways by which somebody can do that. But the first and foremost, I want to drift back to that time in '89 where you purchased your house, and maybe this will give some insight to people who are out there still on the fence. What was the actual impetus other than I want to buy a house? I mean, because there's that psychological barrier everybody has. It's fear. How do you get past that? Or do you give us some insight as to what you did?
Well, our case is kind of funny because my wife and I are both in the business.
Uh-huh.
We were so stressed out during that process, even
right.
though we're in the business. We were like, we had a few arguments going back and forth. It's stressful, man.
Yes,
if you haven't done it before, it's stressful. But if you've got a great realtor and if you've got a good loan officer, like myself, I've been doing this a long time, 27 years now, we can help you through it. And if you have questions about what to do, how to do it, I'm not sure, I'm a renter, I've never bought a home before, what do I do? Call me. Call Jeff. Call your neighborhood mortgage broker. And they'll be able to help you through it. But the point is you have to get in, and you just have to do it because you want to be in a position years from now to have built up, for many people, for many Americans all across
right.
the country, the biggest source of value of their life is their home purchase.
That's a good point, and I would tag that with 99% of millionaires in America did it through real estate purchases. So
exactly right. I mean, not everybody's going to be a tech guru and come up with their own
right.
website designed to be a
right.
millionaire. Most people, if you're just a regular working person, whatever, you're going to build value by owning your own home. This is the way to do it.
Okay, let's get into some specifics. Give us an example or two of some of the programs or something that might be able to help these first-time home buyers, renters, make the transition.
Well, the first one is a down payment assistance program. There's a bunch of them. We're not going to get into the specifics right now, but just so you know that there are down payment assistance programs available throughout the state. Some cities or counties will even have add-ons just for your specific city or county. But we're gonna pick on the big retail banks, Chase, Wells Fargo, Chase, Wells, those big banks.
Right.
You know, they're not going to have all these various programs where us, Jeff, like you and I, and a lot of other mortgage brokers, we do have access to these down payment assistance programs. So if you've got decent credit, if you've been on your job for a while, let's not let the money to buy hold you back. There are down payment assistance programs available. The next would be either a 3 or 3.5% down payment. So if you're listening at home, here's how you figure that out. You get your cell phone out, your calculator on your cell phone. You take a look at a house online that you see that you like to buy. How much down payment will it be? You take the purchase price and you multiply it times 0.035. Purchase price times 0.035 in your calculator. Just that simple. And that'll tell you what your 3.5% down payment will be for that house. That's a good place to get you started.
Okay.
Then from there, so you don't have to have 20% down payment. That's a bunch of nonsense.
Good point. Yep.
You get in from maybe a 0.5% or a 1% down with the down payment assistance. You can get in with a 3 or 3.5% down payment with many of the first-time buyer programs. Then you can get into the 5% down, the 10% down, or 20% down. You hear people talk about if you have the money. Of course, that's a good option for you. FHA is a great first-time buyer program, and the great thing about FHA is they allow for maybe your credit isn't so great. They'll allow for that. I'm helping a client buy a house right now whose credit score is 591.
Wow.
And they're going to be signing the loan documents next week.
Wow, that's interesting. I was just going to ask you, how low does FHA go, and you kind of just nailed it right there.
Well, they'll even go lower than that.
Oh.
You might have to have a little bit more of a down payment. And much of our business right now, Jeff, as you know, is computerized.
Yep.
So we put all this data into the Fannie Mae computer, and if the Fannie Mae computer likes it, you get an automatic electronic approval. There's another way, we would call old school, where the loan is manually underwritten. So there are a couple options about low credit scores. So the bottom line, if you have a desire to buy a house, call me. Call Jeff, for your favorite mortgage broker, because a lot of us, like myself, we have experience in helping clients get through that. We'll say we talk right now and your credit's less than perfect. I will be able to give you specific things on what to do, what to pay off, how to dispute, things like that, so that 3 months from now, 6 months from now, 9 months from now, son of a gun, you did the work, now you're ready to buy because your credit's in order. You know how much money to save. So there's those type of things too. So just pick up the phone and call us. That's the best thing you can do for yourself, honestly.
That's very interesting. Now, a question about it comes up to me all the time now because people tend to never shut the news off when they're stressed. You know, it's one of the things that you can do to de-stress is to take the stressors out of your life. But people tend to do the opposite. So just quickly here, the credit default that may or may not happen. And how it will affect not only the real estate market, but certainly the mortgage interest rates. What are you telling your clients now?
I haven't really got into addressing the credit default thing yet. I mean, that's going to happen on its own. And it's kind of like you think about the stress, like why are we going to stress about something we've got no control over? If it happens, it happens.
That's right. That's
right.
right.
And the bottom line is for people, we'll say, for example, that it does go that there are some default rates. What does that mean to a potential home buyer? It means foreclosures are going to be up. There's going to be a lot of houses that are going to be coming on the market, which means the more houses on the market, the prices come down a little bit. So that's something we can't control. So as long as you have a stable job and you have had for a couple of years and you believe realistically you can make your mortgage payment just like you can make your rent payment, let's get you into the house so we can start building wealth for you and your family.
Okay, excellent. Now, I know that we also do self-employed loans, other things other than your conventional or FHA. Is that right?
Yeah, so let's talk quickly about our veterans. We love our veterans, and God bless you, and thank you for your service. Mm-hmm. There are loans just for veterans, and I'm sure they know about, but if you have somebody in your family, man, there's no reason to not buy a house because we can get you into a house with 0% down payment. It's the best loan in the world is a VA loan.
I agree.
Okay, and the next, there's a lot of people, I'm helping a client right now. They are self-employed, and they literally never thought that they will be able to buy a house, because they're buying a very expensive house here in Los Angeles. It's not $1 million, but it's in the high hundreds, thousands of dollars, and their income only shows about 40 or 50,000. So look, if you're self-employed, we all know how that works. You're going to tell IRS one thing, but we know you're making money another way. So
Right.
there are loan programs specifically for people who are self-employed. We've got we work in conjunction with a CPA to do a P&L program. We can also do 12-month bank statements. We can do 24-month bank statements and a few others. So if you're self-employed and if you write down a lot of your income and your income isn't really commensurate, the tax returns that you report aren't really commensurate with your lifestyle, there are loans for you. We can help you buy a home if you're self-employed. If your tax returns don't show that much, we can help you. If you're an independent contractor, if you're a sales rep, you're a lot of your expenses, we can help you. 1099 contractor, we can help you with those
Hey,
types
Bill,
of loans.
I'm
Yep.
sorry to jump in here, but the producer's yelling at me, so
You got it.
I got to
You
cut it
got
short. Tell people how they can get in touch with you, though, before you leave.
Of course, yes. My name is Bill. My last name is Orr, O-R-R, area code 818-406-4744. Again, 818-406-4744.
Bill, thank you very much once again for coming on the show. Great information. I really appreciate it. Thank you.
You got it. Thanks so much, Jeff.
Thank you. That's Bill Orr from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You know, each and every week we bring to you information about what's happening in the mortgage world. You have a lot of decisions to make, and quite frankly, there's no place to turn if you just want to talk and hear about what's going on in the mortgage world. Now, historically, my particular show has been on the air for about 9 years. If you go to KCAA, and that's the radio station that broadcasts in the Inland Empire, some parts of LA, Orange County, and out into Palm Springs area, they have an archive on their show, and you can hear and listen to shows in the past. We also are on podcasts. You can go to YouTube, Jeff Barton, The Mortgage Voice, and certainly get all this information on the website, themortgagevoice.com. If you want to see and hear me, just listen to the show each and every week. Like I say, we try to bring to you the best of what we can, and it changes from week to week, which is why it's a must listen if you're in the house buying business. With me, once again, is a great person who knows way more about this than I do, is Carlos Velasquez from AHL Lending. He's the branch manager over there, and I asked him to come on just to let us know a little bit of what's going on. Carlos, how are you?
Great, Jeff.
Thank you very
Doing
much.
great.
Hey, and thanks for coming on the show. I really appreciate it.
Thank you for having me.
Okay, so you're in the business, been in the business a long time, and your expertise about what's happening in the mortgage marketplace in your area, in your sphere. Tell us a little bit about what's happening at AHL and exactly what's going on in the marketplace in terms of volume of loans, types of loans you're doing.
Well, currently right now, we're doing a lot of, purchases when we can get them. Everyone's having a hard time right now with the inventory. Prices are up there. Rates have skyrocketed, and just inventory is just really difficult. We're seeing, a lot of people that, they want to get out there and they want to purchase, but there isn't any inventory right now. That's just the way it's been for a little bit. We're hoping, that things start to turn around here in the summer, but it's really hard to say.
Now, when customers come in and they're talking to you about loans, loan packages, what do you see as the major impediment? Is it the customer or just lack of inventory in the marketplace?
For the most part, just lack of inventory in the marketplace. It's still pretty competitive. I come from a real estate background, so the thing is that, there's still multiple offers on properties. People are still overbidding on properties. So that's just the trend right now, and it hasn't changed. It doesn't look like it's slowing down at all because, there's just such a high demand for property.
We've seen in the marketplace a lot of lenders having some difficulties, especially in the first quarter of this year, some mergers and acquisitions. Things are changing a lot. This has happened many times since I've been in the business, and I think you also see that. What do you see as some of the parallels between today and, let's say, back in 2008?
Well, the difference, I mean, from now and '08, I mean, just '08 was just it was just a whole different market. I mean, everybody was basically just qualifying based on their stated income. I mean, that's why they were called stated income loans. I mean,
right.
Pretty much. And nowadays,
Yeah.
I mean, everybody has to, I mean, they're full doc loans. I mean, everybody, all the, basically all the I's are dotted, T's are crossed in regards to verifying all the income documentation, stability of employment. I don't foresee the same thing happening in today or any time in the near future as to what happened back in '08. I mean, it was just a completely different market. I mean, everybody usually right now, I mean, adjustable rate mortgages, I mean, are not the trend right now. I mean, everything is pretty much a fixed rate right now. So these people are locked in, everybody that's purchased in the last couple of years are locked in at a low rate. So, and I think that's what's causing the market. I mean, the inventory. I mean, so many people that own property right now, it's like, why am I going to go sell my property and pay double for a property right now and also maybe double or triple my interest rate that I currently have?
Right.
So that's what's going on. So people are just staying put as, where they're at and not making that move right now.
Yeah, and I think unlocking the frozen aspect of the market is going to take a long time because, as you just said, if I'm somebody who bought a house, maybe it's not my perfect house, maybe it's not the house I wanted to live in and for the rest of my life, but if I'm paying 2.5% on a mortgage, there's no chance I want to go out there and spend more than I spent for that first house and obviously spend more on the mortgage interest rate as well. I'm just not going to want to do it.
Correct. I mean, I was talking to a friend of mine. I mean, it would be interesting if they could offer some sort of a bill. I mean, come out with some sort of a bill or something where, there could be some sort of like incentive for sellers that want to, upgrade their homes, maybe, getting that reduction of rate. And that way it would open up the doors for new potential first-time home buyer to be able to buy their property. You know what I mean? So,
well, yeah. I mean, I earlier in the show talked about the home builder sentiment, how that's reached finally positive territory. But really, we're talking about we need wholesale new homes. We just need new product on the market because, we've been short in the market since '08 because nobody wanted to get into a situation where they were overextended like they were at that time. Where they were rolling houses off, especially in places like Utah or Florida or Arizona. Nobody wants to do that. Las Vegas. So I think home building itself, obviously we want to see more of it. And I don't know if you see much of it happening down in your area.
Yes. We actually, there was an article that came out today. I mean, it says that, that construction is at all-time high. I mean,
great.
I don't know where I saw it, but I saw it somewhere. I think it was this morning. Every morning I glanced through all the articles, and every day it's changing. So, yes, I mean, there's a lot of stuff, construction right now. It's in very high demand.
Now, automation. Now, we take a 10-year window here. 10 years ago, we didn't have the type of automation that we're going to have. And coming forward into a mortgage company near you will be artificial intelligence and the way that can streamline a lot of processes. For instance, if you're talking to a lender, you may not be talking to a lender. You may be talking to some automated voice that will tell you or talk to you. And do you see this not only, obviously, it's going to expand the margin or bring some of those savings to the borrower, but do you see this as a trend in the industry coming soon, or is it going to take some time?
Well, I think it's going to take I personally think it's going to take some time, but it is coming. I mean, Everybody's talking about it. I mean, just kind of like when social media came out, which was like, maybe 5-6 years ago. I mean, everybody was just kind of surprised about what was going on, and everybody that was doing it, people thought they were crazy and stuff, but it's now the trend. And now everybody's talking about, people can get ahead of the game on artificial intelligence, that's where it's going. I can't say for sure exactly, where it'll end up. But I mean, I think people still like the fact that they need to interact with people. So I think a lot of companies have tried it. Some of the larger companies have tried things like that. And for some reason or another, it just doesn't seem to always work. I mean, it's kind of like me trying to go on to, customer service chat with, a vendor or somebody, and, you type in your question and, it kind of redirects you to something. It's like, no, that's not what I'm trying to do.
No, I understand. That's true, by the way. And talking to anything online is always frustrating because you're never quite sure who you're talking to or what you're talking to. Just
Correct.
wanted to talk to a person that can answer the question, which is, which box do I choose, A or B? And they want to give you an explanation about 57 other things before you actually get to your question. Happened to me the other day. Very, very frustrating. And then you're on hold, of course. And I think these types of situations will take some time to iron out. But I do believe that you will find, and you're in the business long time, and your expertise is in bringing a loan from A to Z, seeing it close out. Those steps in between there are some of the things that I'm talking about, maybe not seen by the general public on a daily basis, but in terms of processing, in terms of how the loan gets looked at, whether it's credit score, whether it's AUS, or whether it's any number of other processes, work-related, checking verification of employment or income. All these things can be done in an automated fashion through pretty much without human beings. And I think that integration is coming. What are your thoughts?
Oh, no, absolutely. I think it is coming. I mean, I use, chat, whatever
Right.
you call it, chat, GPT, whatever it is.
That's
I
what it
use
is.
it all the time because, for certain scenarios, like, I'll just type in like, an underwriting question or a guideline. And rather looking it up myself on Google, or, usually like, the like an FHA handbook or something, I mean, I'll just go to the chat, and the artificial intelligence, I type in the question and it gives you the answer. So,
Right.
A lot is happening, Jeff, and it's coming really fast. So
Right.
technology is, I mean, it's kind of hard to keep up with it.
No, it really is. We're out of time here. We're at the end of our rope. But I'd like you to shout out your phone number so people can get in touch with you, especially if they need a great lender and a lender source at AHL.
Yeah. My number is 714-604-7600. I can put you in touch with one of our loan officers, and that we'll be glad to help.
Thank you very much for coming on the show, Carlos. I really appreciate it.
Thank you so much, Jeff.
Thank you.
You have a great day. I look forward to your show.
Thank you very much. I'm Jeff Barton, the voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us week after week, month after month, year after year. Yes, we've been on about 9 years, hundreds of shows. If you want to hear or listen to any of these shows, several places you can go. Best place is KCAA.com. You can go there and listen to me and the archives that they have. I've been on that radio station for a long time. You can also go to YouTube. Jeff Barton, the Mortgage Voice, is the show on YouTube. As I said, we shoot this for YouTube so you can see my pleasant face as well as the picture of our guests. If you want to see the guests a little bit more, you can go to the mortgagevoice.com, and that's our website. We're also on a number of different podcasts. Daryl, do you have a couple of those podcasts for us?
I sure do, Jeff. We're on Apple Podcasts, we're on Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, Podclips.io, and the Mortgage Voice as you spoke about.
Yes, exactly. Okay, thank you, Daryl. Thank you very much. Okay, so that aside, I am Jeff Barton, and this is the Mortgage Voice. And joining us, who has been on the show many times, and I thank Livier Becerra for coming on once again to help us really understand what's happening specifically in this particular market in Southern California. Livier, how are you?
I'm good. Nice to talk to you guys. It's been a bit.
Yeah, I know. It has been a little bit of a while. I check on the cell phone, and it said October. I'm like, can't be October. Is it really that long?
I think so, but it's always nice to chat with you guys.
It is, and I appreciate it. Livier is one of the top real estate and mortgage professionals at Malibu Funding, and really appreciate what she does for the business. Give us your perspective as to what's happening both in the mortgage world. I know that rates have really hurt a lot of volume, but are we seeing any new types of business that are, I guess, used to the rates or getting used to the rates, and they're not so high in their mind anymore if they can afford it?
Well, like anything else, everyone just adjusts to what's going out. It's not like we have a choice, right?
Right.
So
That's true.
if they're purchasing a house or if they're selling, they're going to miss their 2%, 2.5%, and they're going to have to acclimate to their new 5.75 or 6.5, whatever it is. But
Right.
I think, there's really not a difference between one always affects the other. The high rates affect the real estate. What's going on in the real estate is going to affect the rates, the mortgage industry. So, I mean, I was having a conversation with my title rep just this morning, as a matter of fact, and a couple months ago, there was maybe 100 defaults, NODs, notice of defaults, that had been filed. As of a couple of weeks ago, there's 300, and that's in LA. That's in LA County, by the way.
Right.
So that will, everything right now is supply and demand. So there would be more supply, which will also affect the rates. So there'll be less fighting over homes. There'll be more properties where you can make an offer on, and you won't have 10 people fighting you for the same property. So I think that, although it is discouraging, to know that there's that many notice of defaults, but there will be more properties on the other side that will be available for buyers. Now, and hopefully it will bring the prices down some and stabilize them.
Yeah, no, that's an interesting analysis, and that great fact that you went from 100 to 300, but 300 in a city of 10, 15 million in the county is really a drop in the bucket in terms of supply into the marketplace. If in fact those houses even get to the market, the way corporations sweep in, buy them all, and then just rent them out and look at the margin better that way.
That's very, very true too. But as a seller, if I was to be in that same situation, I wouldn't sell to somebody, because they're going to buy them for pennies. But, as somebody who's going to sell their house, you want the most, especially in this market, and you're going to want to get the most for the property. And I don't think those type of people want to pay the most. But I think when we'll get there where they buy the huge, packages of the foreclosures when we're, if we were ever to be in another bubble, then that's where they rake them in.
Okay,
but
interesting.
I think right now.
Yeah, no, I was just going to ask you a little bit about what was going on with the economy. The dreaded predictions of the recession that is coming, that keeps on coming but never get here kind of thing, and how that necessarily will affect supply and demand of the product in the real estate world.
Well, it all depends where it lands. I mean, if we could predict the future, I would be so rich. So, but
I'd have spent it already. So,
we'd have pre-spent it.
Yeah, exactly. I owe that money. What do you mean? That's funny.
So yes. So we'll see what happens. We're seeing things or hearing things that by the midsummer, what might happen if the Fed coin comes in, how that will affect, and how the transition would even affect, us not only just as a nation, but as a world. So it's interesting and scary, but, one day at a time, and just go with, however it happens, we're going to be here, and we just have to, like we said before, we'll have to acclimate, we'll have to adjust, and there you go.
Do you see a difference in the type of loans you're doing today than you did 2 years ago?
Well, I'm very blessed. I am still busy. I have way more purchase loans than I do have refinances. But I also do real estate, so I do keep busy. But again, more purchase. I'm seeing a lot of bank statement loans for self-employed.
Okay.
And which the bank statement loans, as you very well know, you just supply 12 months worth of bank statements. Could be personal or could be business, and then we add up all the deposits, we divide it by 12, and boom, there's your income right there. So it's a great way for self-employed to get. So I'm seeing quite a bit of that, but a lot since they raised the conforming loan limits. It really eased up so people can buy a decent house in San Bernardino, and as you know, there's a lot of nice areas in San Bernardino, Riverside County. So those limits were kind of ridiculous to begin with. So
yes, they were.
It's nice to see them up.
Yeah, I think they were still thinking last year anyway about 2008 and 2009 when 2/3 of the value of the homes went down. So they were never wanting to lend more, especially when the prices there rose as quickly as they were rising in L.A. and people were moving there. Demand got up. Multiple offers on many, many different houses. So, yeah, it's nice to see it. What is the conforming limit out there now?
I believe it's 726 and change.
Right. and that's nice. I mean, I've friends in Rancho and a number of other places, Riverside, and so they're all happy that's available because it brings in a whole new pool of buyers.
It does, because in those like Chino Hills or
Right.
Chino, where you have homes over $1 million, and Rancho too, I mean, they would be stuck with a jumbo even if they were at 700,000.
Right.
That was kind of ridiculous. So it kind of limited the growth, I believe, in those areas for somebody with it limited buyers.
Right.
Is what it did.
Right. Obviously, if you're coming from some parts of Los Angeles where, $1 million, especially even in Orange County where it's over $1 million, the median home price, and you want to move out to there, you want to be able to get the best loan you can possibly get. There's no reason why the demand will be lessened unless, of course, it's more difficult to get a loan that you can afford, and that's what was happening.
Right. Yeah. Remember when they were like in the 400s? It's like, okay, you're going to buy $1 million home. You have to come up with 600,000 if you want a conforming. And now, it's a much different ballgame. 300,000 is a big difference.
I agree with you 100%. Okay, prediction time. Where do you think we're headed in the next 3 months? Do you think the Fed will ease up on rates? Do we see a Fed cut by the end of the year, which would also help the mortgage interest rates go down?
Well, what I'm hearing is that they are going to come down by the end of the year, that we should be in the upper fours.
Wow.
And you know as well as I know, we go into an election year and they always drop the rates.
Yep,
So
I agree.
Don't cry over your 7 or 6%. We'll see you in about 6 to 8, 9 months, and we'll get it right back down for you.
Right. I believe that. I think getting into the house is important. Looking forward to the refinance is great because I do think that's happening, and I agree with your election year. I just think that what we're going to see is either by the first quarter of next year, we probably won't see anything happen because Fed doesn't like to get involved in politics, even though, like what you said, is also true that we tend to see interest rates lower during election years.
Absolutely. I've seen it. I've been doing this almost 23 years, every single election year, always.
It's unbelievable, isn't it? Hey, Lavere, could you shout out your phone number, a way by which people can get in touch with you, especially if they need a great person in the real estate world, mortgages or real estate?
Yes, absolutely. My phone number is area code 626-712-9920, 626-712-9920. You can call me Liv if Lavere is too hard for you. But, I would be glad and appreciate the opportunity.
Thank you, Lavere, very much for coming on the show. Always enjoy it.
Thank you. I appreciate it.
Thank you.
Nice talking to you guys.
Nice talking to you as well. That's Lavere Becerra. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. Each and every week we come to you, bring you information on mortgages, on real estate, some guests that come on the show and talk about specifics in their particular area of expertise. If you want to hear us on podcast, we are on any number of different great podcasts. And I think, Daryl, you have a list of those?
I think I might hear, Jeff. It's Apple Podcast, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, Podclips.io, and themortgagevoice.com.
Okay, excellent. That mortgagevoice.com, that is our website. If you go there, you're going to see our guests that are on almost every week. You can get in touch with them directly, or you can listen to the show. Podclips.io, great central location where you can go for all your podcasting needs. They have a number of different things. And by the way, if you have, the want to do that, sign up. Tell them you like it, and you can get all the alerts of the different shows that you do like, whether it's health or finance, sports or lifestyle, any of these things, podclips.io. Go there for your podcasting needs. Okay, I am Jeff Barton. This is The Mortgage Voice. Let's get right to the rates. Talk a little bit about what's happening in the mortgage world. 6.69 is the 30-year fix. 6.05 is the 15-year. 6.34 is FHA. 6.40 is the jumbo rate, and 6.85 is the 5-1 ARM. Those are the mortgage rates. They are up this week a little bit. We were talking a little bit off air about how rates had been coming down for a couple of weeks, and we were seeing 6.5% as the 30-year fix, hoping for a continued trend downward, which had been going on for the previous 3 weeks. Well, this week we see mortgage rates tick up a little bit, and obviously that's stressful news for those of you out there who have yet to lock your loans, and you're in a purchase, or you're looking for a home and you want to obviously get the most for your money and not pay as much as you want to. But the 2-year is at 4.103. The 10-year is at 3.56. We are almost at a half a point in terms of the spread between the 2 and the 10, and we still are predicting that recession, whether it's mild or whether it's not mild, probably coming in Q3 or Q4 this year. The economy is slowing a little bit, people keeping money in their accounts, not spending as much as they were. So all of that really leads us to believe that, yes, we will get the slowdown. Whether it tips into a recession or how much and how long is really about the Fed. Fed may raise their short-term interest rates one more time, 25 basis points. May cool off, hold on for a while, and see what happens at the end of the year. If we go into a serious tail spin, we probably will see a rate cut, although the Fed doesn't come right out and say that, because that would make the stock market and everybody else go cuckoo. But that's what I think would happen. I mean, this is coming into an election year, and the Fed doesn't like to do anything during an election year that would upset that particular election cycle. So if they were going to cut, they probably would cut by the end of the year, early in Q1, before it got into silly season, which is, the election cycle that's coming up. And by the way, the election cycle that comes up really is respondent to many things that are happening in the news. And because this is such an unusually volatile group that we've had coming around, same guys, probably the same time. How does that affect mortgages? How does it affect the availability of real estate? Well, it's interesting. I read today that the Home Builders Association of America, let me just get it right for you so I don't screw it up. Let's see. Where is it? No, I don't want to read about the bathrooms in America, although that was interesting too. Home Builder Housing Market Index is up 5 to 50%. Now, we all know that any of these indexes at 50% means that we're in positive territory, which is the first time in 5 months that the home builders' sentiment, that is, if they survey a bunch of people in the home building, whether it's Lennar or whether it's Aspen or whether it's Broad or, any number of these larger home builders, their sentiment of the positivity of how they feel about what's happening in the home building section is at 50, which is a positive. And it's, as I said, the first time in 5 months that it's been in the positive. And it's the 5th month in a row that the Home Building Housing Market Index is up. One of the reasons that they say, one of the main reasons that they say it's up is because there's such a lack of housing. Now, we were we were predicting at the beginning of the year, and this is why prediction in the real estate world is so crazy. I don't know if whatever website you go to, there's always somebody that is the outlier that'll say, oh, no, I know what's going on, whether it's Michael Barre or whether it's Jamie Dimon or whether it's El Arain, Mohammed El Arain, the economist. All of them are predicting a certain thing, and it's usually an outlier of what the main body of thought is. In this particular way, the main body of thought about what's happening in the economy changes, and it's changed for me too. And I think because of that volatility, a lot of people are, searching for security. One thing that you can do in any market to get security is own property, as everybody knows. We've said it, and all my guests say it who come on the show. They say, look, if you can get in and you can afford the price of the house and the monthly payment, what difference does it make what the rate is or what the cost of the house is? But because the availability of housing that we thought would increase because the demand would be less and people wouldn't want to pay the high price and mortgage rates would be falling, we would get more housing in the market. Well, that didn't happen. Just the opposite happened, which means that the home builders who were afraid to build houses at the beginning of the year now are not so afraid. And the reason being is the demand is there. Look, we don't have enough houses for people. We're millions of houses behind of where we should be. And obviously, we see more and more opportunity as we go forward in this year because fewer and fewer homes are on the market this year than last year. And last year was a terrible year for availability of properties on the market. So that's why the Home Builder Survey is what it is. It's up and it's at 50%, and that's probably a pretty good thing. If jobs, here we go. The unemployment is at 3.5%, but jobs available now, 1.6 to every available worker. That's down the lowest in 2 years. Now, we talked about this earlier in the show. One of the things I didn't get to was, what does this actually mean? 3 things that it means, okay? If jobs losses, meaning if this trend continues where fewer and fewer people are available for work, but the number of overall jobs available also falls, we're signaling that the recession is coming. And that if that happens, then other dominoes fall, meaning that if one thing happens, we're going to see a 1, 2, 3 effect. We're not going to see this kind of, okay, housing's terrible, but mortgage rates are low. Or mortgage rates are low, but there's no housing. All of these things, here's number 2. Car loans will default if the jobless delinquency rate on car loans up for the year. Okay, so a lot of people don't realize, but the second major purchase in most people's lives are the car loans. Car loans you would have for a brand new car or a used car. And these delinquencies are up. So if you get job losses, you're going to get car loan defaults. As I said, the car loan defaults are already up this year. And these 2 things combining, this is what I say, it's a cascading domino effect. And I think that's, even though as confusing as it sounded when I said it, that's really what worries economists. And I think that's why a lot of people are worried more about the economy now, even though the unemployment rate is so low. And the third one being credit card debt. Now, credit card debt has topped $1 trillion, okay? Credit card debt, $1 trillion. Debt owed by consumers in the U.S. is $17 trillion. Now, that includes home mortgages as well, right? So just to give you an example of credit card debt and what it looks like today versus last year. In 2021, 2 years ago, was $108.1 billion that was paid in interest and fees. Sounds like a lot, right? Following year, 2022, the number was $133.1 billion interest and fees on credit cards. That means that people are borrowing more on their credit cards than they did the previous year. This year, going to be up again. And that's what worries me, worries a lot of people. Credit and how it's given and how we are able to, lend money is all dependent on how people feel about the ability to repay the loan. All of these things are what's happening. Anyway, there's a lot of stuff here I want to get to. We'll try to get to it during next week's show, but I really appreciate you listening to me this morning. I'm Jeff Barton, your voice in the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
Thank you, Inland Empire, for listening to KCAA Radio.
Taheebo Tea Club's original peer